Good afternoon, Carl.
Good afternoon, Anthony. How are you?
I'm doing great. I'm doing great. Excited. Before I know we're gonna get started in 6 minutes, but excited to speak to someone in South Africa. I lived in South Africa for 6 years and a half, so always have,
Fantastic.
um, always have.
In Cape Town or Johannesburg?
Yes. I lived in Johannesburg.
Okay.
It was great experience. Where are we currently based?
I'm Cape Town.
Nice. I hear a lot of good things about Cape Town lately. I only had the opportunity to go there 2 or 3 times, but it's a beautiful city.
No, it's a great city. Listen, we are so blessed with what we've got here. Mountains and sea.
Exactly. Exactly. Very nice.
And fortunately, with lockdown, we pretty much free to do as we please right now, unlike the rest of the world.
Say that again, sorry.
Through the lockdown process with COVID, we pretty much operate as we need to in Cape Town. We don't have restrictions like the rest of the world at the moment.
Wow, that's great. I mean, especially during such difficult times, that's a really good thing to be confronted with, having the flexibility to move around.
Exactly.
Very nice.
Yeah. So well done for what you're doing with Africa Startup, eh?
Sorry?
Well done for what you guys are doing for African startups.
Thank you. We're trying. We're doing our best. It's an exciting journey, and very happy to have the opportunity to have an impact and working towards creating more impact on the African continent.
Fantastic.
I had a question for you before we started. I'm just trying to remember it right now. Well, it will come back as we move forward toward the conversation.
Okay.
Great. I think we'll have 3 more minutes before we get started. Actually, this was my question. In Cape Town, right? Are there a lot of, how international is it? I'm hearing a lot of people from the US and from Europe that have been moving to Cape Town. How does that look like at the moment?
In the fintech ecosystem or in general?
In general. And then you can tell me a little more about the fintech ecosystem.
There's certainly, from what I can see, there's a much stronger ecosystem in Cape Town for tech and fintech, and it's attracting people from all over the world. So we have Germans, Austrians, Dutch, Americans, so from many different parts of the world, living in Cape Town, building startups. More so than Johannesburg as an incubator. So it's very much centered, and you tend to find these places in cities where people want to live. So that's what attracts the creatives and the startup cultures. So we have a good ecosystem here.
Very nice. I have a friend who's an artist in Cape Town. she's exactly, it's funny you mentioned she's half Austrian and half Italian. So you touched on that nationality in your description.
There we go. Yeah, it's a beautiful place to live.
I'm looking forward to come back. Once the pandemic is over and things are easier, especially to travel, I'll definitely make my way back to South Africa.
Absolutely. And look us up and we'll show you around.
Oh, please. I would love that. That would be great. That'd be fantastic.
We'll introduce you to all the people in the startup ecosystem here.
All right. Well, I'm sure Boum is listening as well. So Boum, you're hearing that, huh? What a good opportunity.
I'll definitely take Carl up on that.
That's for sure. Thank you for that.
So we have something called Silicon Cape.
Oh,
a much smaller version of what you have in the West Coast.
Nice though. I like the name.
So you're about to start. And then they call the Nairobi one Silicon Savannah.
Nice.
All these offshoots.
Those are good names.
Anthony, do you have the YouTube live link pulled up on your screen?
Just give me one quick second. I'm pulling it up. Yes, I do have it right now. Let me just mute it. Good names. Yes, I have it on. Yeah, it's on. And we actually already have someone saying hi from Nairobi.
Fantastic.
That's a way to start.
They have a great ecosystem there.
All right. Boom, whenever you're ready, you tell me, and I'm ready too.
All right, 1 second. Seems like my mic. Okay.
Already. Oh, I love it. You have the t-shirt on too. Same here. Fantastic. Great.
Perfect.
Can you see me?
Yeah, all good.
All right.
All good.
All right. With no further ado, I want to welcome everyone that's watching us to our 5th episode of Let's Talk Startups in Africa. It's a speaker series of fireside chats with entrepreneurs and investors that are paving the way in Africa. And today we're very excited to host our special guest, Karl Westvig, CEO at Retail Capital SA. Before anything, I just want to tell you a little bit more about Africa Startup Lab. Africa Startup Lab is an organization whose mission is to empower entrepreneurs solving Africa's biggest challenges by bridging the information, resource, and financing gap. Before kicking off the interview, just a little housekeeping rules. The talk will be interview format, and we'll open the second half of the talk to questions from the audience. So we invite you to post questions in the live stream, in anywhere you can see a chat, so we can make sure that we can get to your question. Please share it on your social media as well, so if others are interested in joining our conversation. I will be monitoring the chat. I will kick it off to Boum, who will be moderating the conversation. Thank you, everyone.
Thank you very much, Anthony. And thank you, Karl, for being here. So without any further ado, if you could please introduce yourself to the audience here today.
Sure. Thanks, Boum. Thanks, Anthony. So I guess in very short, I've been an entrepreneur now for probably 25 years with many, many startups. Some successful, some not so successful, and I'm happy to share experiences on both sides. My background has largely been statistics and credit risk. That's my ultimate training. And as a result, I've been involved in consumer finance and more recently SME finance. So very much in the funding businesses. And I guess the one key lesson I've learned is whenever I've been involved in lending businesses, I'm generally successful. Whenever I try something else, even though I think I'm smart, I've been less successful or a failure. So stick to your knitting is the key word.
That is very interesting. So maybe let's start from the beginning. So you've been an entrepreneur for 25 years and have, like you said, have gone through several different businesses. What has been that thing that has always gotten you back to wanting to start a new business if the previous one was a failed, or wanting to engage in a new adventure even after success?
It's a great question. So my DNA is I'm a builder. I love new ideas, conceptualizing them, and then seeing that to fruition. So I guess it's a bit like someone starting a puzzle. You pull this puzzle out the box, a whole bunch of pieces, you put them all together, and you complete the puzzle, and then you start all over again with a new puzzle. And it's not too dissimilar to that. And the other thing I learned early in my career is I work well with people. I don't work well for people. And it's important to understand what your makeup is. And I spent my first 3 years sort of in corporate world, where I learned an incredible amount. I mean, if I hadn't been to that corporate experience, I think it's also a lesson for entrepreneurs is get some corporate experience. I had 3 years of corporate experience. The first year I learned a ton of stuff about structure, about funding, about organizing yourself, etc. Second year, I implemented a lot of what I'd learned. By the third year, I was banging my head against every rule in the book. And that's when I realized I've got to go do this for myself. So I stepped out into the big bad world, got involved in a startup at that point, but was well capitalized. So I wasn't taking financial risk at that point. I didn't have equity in the business, but was involved from an empty floor through to building a business. And then by the third round, we were saying we'll do it for ourselves. Let's go and find capital. Let's go find people. And let's go and build these things. So you learn very quickly in this process about what you do and don't like. And being an entrepreneur, it's a hard road. It's rewarding, but it's a hard road.
So I hear that the lesson here is to know yourself. And it seems like that has been one of the driving forces in your career is you've known from the beginning what you wanted to do and what you liked and what you didn't like. And it seemed like you've pursued that throughout. So tell us about your first entrepreneurial experience, the first business that you ever built and how that went along.
Yes. So I'll probably go back even before my corporate experience. So I spent 6 months working for it was a market research business. I had a stats degree. I thought, I'm going to use my stats degree in this research business. And the level of stats required was so basic that you don't actually use your degree. And after 6 months, you realize you're just being exploited. They're paying you next to nothing. They're billing you out at multiples of your salary. I mean, many multiples of your salary. And you cheap labor, effectively. So I lasted 6 months and packed it up and said, I'll do this for myself. And there was my first big lesson is I stepped out into the world with a degree in stats, some experience in market research, and now you approach the large corporates to do the same type of deal you were doing when you were at this corporate. And you find out the first lesson is that if you don't have a brand, no one wants to pay you. So as a one-man band, there's no recourse if something goes wrong for them. There's no backup if you get sick. There's no, when they go and present this fee structure to their board, they say, who is it? Is it a big four accounting firm or not? And you quickly realize that a one-man band doesn't build big businesses quickly on its own. So that was my first big lesson. So you end up doing small jobs, and that forced me back into the corporate world to go and get some corporate experience. And then probably my second entrepreneurial venture. So that, as I said, the second round for me after the corporate was we had capital with a startup, but we didn't have any equity in it. And then by the third round, we found a large corporate who had a big database of customers, they had a strong balance sheet, and they needed management. So we ended up getting sort of a 30% stake in this venture. We'd already proven ourselves previously with the same product. So actually it was a very easy build because we had captive audience, strong brand, lots of capital, lots of corporate backing, and we could ride on the back of all of that. So where you've got that, it makes it very easy to build a new business. The downside is you're a small minority and you essentially are a well-incentivized management team. You're not entrepreneurs. Does that make sense?
Yes.
Only later on you realize that they put all these shackles around you. As long as you operate within the original mandate and the box that you were given, no one gets involved and no one interferes. The day you want to step out and try something new, then there's debates forever. And and I spent sort of 8-10 years in this business. By the time I left, and someone said to me, it's a bit like getting decisions out of corporates is like swimming through treacle. And that's frustrating for an entrepreneur to try and get stuff done, and you just can't get stuff done. Everything is so slow, so much lobbying. And at that point, it forced me to look at yourself and you go, I've done well out of it. Thank you very much. Now I want to build a venture where I can have more control and I can have more say in the outcome. And I don't have to lobby 2 corporate boards every time I need to do anything. But I think the lesson for me in all these processes was I didn't go straight into the one where I owned the business outright and could make my own decisions. There were stepping stones. I had to go through the corporate experience to understand structure. I had to go through building a business to understand how all the parts get put together, and a track record. Then with a track record, I could get a minority stake, and then with success in that venture, I could then get a majority stake. So for me, it was stepping stones, which I think is quite different to where many of the fintech and tech entrepreneurs approach it now, where they want 100% and trying to maintain all the equity and grow fast and from day one.
Yeah, so let's actually talk about that, because we've seen, especially in tech, that the entrepreneurs get younger and younger, and like you've referenced, are maybe slightly more ambitious from the beginning and do not want to maybe trust the process of time. So what is your opinion on that, and what would be your advice to people wanting to start out as tech entrepreneurs and how they could approach that? And maybe talk about in your experience, the profiles that you've seen, to succeed. Obviously, there's not a one size fits all, but what you've seen to be a better recipe for success.
Sure, it's a very big topic. Okay, let me try and take it.
We can break it down. That's fine.
Okay, so I think you don't underestimate. You want people to be ambitious, and you want people to have big dreams. That's what makes successful tech businesses. That's why we have Amazon. That's why we have Google, et cetera, et cetera. So you want people to be challenging the status quo, bringing new thought to disrupting marketplaces. So that's necessary. What I think entrepreneurs underestimate is that there are lots of growing pains. It's easy to manage yourself. It's easy to manage a team of 5 people or 10 people. It's very hard to manage 150 people, and it's almost impossible to manage 10,000 people. Okay, so, and in that process, and it's a bit like, if you think of the human body, how everything has to work together as an ecosystem, as a system. So you don't, and maybe a good analogy is, someone I met many years ago said to me, building a business is like a tree. The faster it grows, the less stable it's going to be, because it doesn't have the roots. You've got to create the foundations and the root infrastructure to support the tree. And that's, I think, what many of the entrepreneurs miss, is that they want to get $0 to $1 billion in 2 years. And to get to $1 billion, you need infrastructure. You need a culture that people can buy into and work together. You need strong systems infrastructure that's scalable. You need operations on the back end. There's a bunch of stuff you've got to have in place before you can become $1 billion company. And that goes back to another mantra of mine, which is, it takes 10 years to become an overnight success. Everyone wants to rush the process without having the infrastructure in place. So I think you do want people to challenge themselves and have ambitious goals. It also helps them raise capital by telling the story. They've just got to appreciate that they've got to somehow bring the experience in to build the foundations to support it. I don't know if I answered your question.
Yes, you did. And going back to the tech ecosystem, and maybe specifically in South Africa, you've been there quite a long time. You've seen it evolve. What are the things that you've seen change over the past 10 years, maybe?
So, 10 years ago, it was very much everyone did it for themselves. There wasn't an ecosystem as such. And the ecosystem is made up of a bunch of components. Funding is just one piece of it. And we have probably a fairly immature VC market in South Africa relative to elsewhere in the world, and relative to sort of the West Coast. And we can talk a bit about that. But what's certainly developed is we have something we call Silicon Cape. It's a bit of an offshoot of Silicon Valley. And I know Nairobi, I think they call themselves Silicon Savannah. So that ecosystem is being built where entrepreneurs have somewhere to go to, so that they can get infrastructure as a starting point, where they can get bandwidth, they can get desk space, they can get mentors. And that's probably the biggest thing that you need, is you need gray hair around the table who will come and support you. And that shortens that life cycle to build those foundations, because they can teach you the pitfalls before you see them, before you hit them. So there's certainly an infrastructure that's being built around advisors, mentors, accounting platforms. Many of the businesses don't understand the value of governance and good corporate governance. If you want to raise capital, people need to trust your numbers. They need to trust your decision-making processes. So that needs to be put in place. So that's what we've seen building out in South Africa, where there's a strong, everyone knows everybody in various entities. They share experiences. There's good mentors being built up. There's physical places, meetups. So there's an ecosystem which is supportive.
Okay, you talked about corporate governance, and that's actually a very interesting topic. So how have you seen it being done successfully, where those acceptable practices are being adopted by businesses? What have you seen being the best incentive that has spurred that shift to better corporate governance for businesses? And maybe you could take a case of South Africa specifically.
The best incentive for corporate governance is your valuation. And if no one's motivated by having a high valuation, then they're missing a trick. So and I can speak from experience. So when we set our first business up, when you're a two-man band, you've got management accounts, basic stuff, and you go to sell your business, you might get, in our world, in those days, it might have been a 5 times profit after tax type valuation. But as soon as you inside a larger corporate structure where governance is imposed on you, so in our case, we had 2 large corporates, a bank and a retailer. They had board structures, they had minutes that were put out on a regular basis. There were decision-making processes, mandates were set up. And when you do your next deal, you're getting double the valuation just because they trust the numbers that are coming out and the partners in the business. So my advice is you don't need massive governance. You don't need to be managed like a bank. You don't need to have all that red tape, but just a board with some independent non-executives who've experienced, some risk management principles around identifying risks to the business, be they financial risks, be they corporate risks, whatever it is. Identify what they are, put some mitigation around it. It doesn't need to be over-engineered. But when someone walks in and there's a set of board minutes that's clean, there's a set of financial statements that are signed off and not qualified, there's some gray hair on the board and independent that can oversee some of the decisions, your valuation goes up. People trust what comes out.
Amazing. So I'd love to go a little bit deeper into the finance and fintech world, and maybe jump and talk about retail capital and your activities in the credit space. So let's start a little bit about what are the differences that you see maybe across different African countries in terms of assessing credit.
Also another big topic. Okay. Well, let me talk about our journey, because I think it's fascinating. Retail capital didn't start as a fintech. Retail capital started as an SME lender with very traditional processes and very manual processes. So it's a 10-year-old business now. When we first kicked the business off, we were collecting paper documents. We were manually capturing it. We were doing manual assessments on deals and dispersing the money and collecting. Okay, so it was a very untech business 10 years ago. About 6 years ago, we radically changed the business in what we call the higher touch, the larger deal sizes. we were doing, we automated all the processes. So we digitized the process. We didn't create a fintech business. We digitized what was already there. So we would get direct links into the banks to get the bank statements. We would have direct links to the bureaus to get bureau data, and so on. And then we were doing automated underwriting. The fintech part later on came where we started working with partners that had better data. So, the basis of our business is we fund SMEs, SME retailers in particular, and we fund them against their future cash flows. So if you take a restaurant owner, we will give him a capital amount up front, and we'll then collect an agreed percentage of their turnover in the future. Okay, so we'll collect 10% of their daily takings. So 90 will go to them, 10 will come to us on a daily basis. Okay, so we only success if they're successful. And the more successful they are, the quicker we collect our money. Okay, so it improves our yield. So that's the fundamental basis of it. We then started working sort of 5 years ago with partners in the acquiring space. So they were processing credit card transactions. And we said to them, provide us your raw data on transaction level, and write down to every transaction, date, time, stamped, etc. And we now crunch that data on a monthly basis. It comes to us anonymized. We don't know who the merchant is, but we can see what the data is. Based on that, we then have risk algorithms that calculate what we're prepared to be exposed to with them. That then gets made available through their own digital portal. So it could be on an app, on a web portal. They'd see that they qualify for $10,000 and they have 6 months to repay. And at any point, it can be 3 o'clock on a Thursday morning when they need stock for the Friday to trade. They can log onto their portal. So I need $5,000. I want 4 months to repay it. Accept, deal's done, money gets paid out. Okay, so all the work has been pre-done, completely pre-qualified, takes them 30 seconds to draw the cash, which is unheard of for an SME. I mean, SMEs typically have to go and beg banks and take 6 to 8 weeks to get the money. So that part of our business is completely fintech. We never see our customer. We never have to ask for information. It's all pre-qualified and delivered to them in their own platform. So, and what we're seeing in terms of the shift is data is definitely the new gold. It's the new currency. The better the data, the better the customer experience. So rather than going through a 3, 4, 5 day approval process, I can be told up front, you already qualify just by virtue of the fact that you're a customer of XYZ acquirer, and the money's available already without even asking for it. Okay, so user experience is far better. Take-up rates are far better. Bad debt experience is great. I mean, we can talk about types of data that's available. I mean, there are guys that are experimenting with psychographics, they're experimenting with social media data. So there's a whole bunch of guys building scorecards using different data across Africa. But at the end of the day, a digital transaction is gold.
Yeah, and actually, that was actually my follow-up question around the type of data collected and also the incentive for the different data holders to provide that data. So you might have enjoyed the fact that retail capital already had existing partnerships and you could tap in, but for a new player looking to kind of build an infrastructure or maybe be a data aggregator, a facilitator, that could be somewhat difficult. So, how would you describe those incentive mechanisms to collect the data and make the data more available for these types of services?
So underpinning all of this is trust. I'll get to the mechanism and how we do it, but underpinning is trust. So the first thing you need to do is make sure you're a credible player. So they're prepared to share data with you. Okay, so we spend a lot of time making sure that we make sure we manage our data and we make sure that there's no data breaches and it's et cetera, et cetera. In terms of the incentive structure, so we work with two models typically. At the end of the day, our partners want to create more stickiness with their customers and they want to earn some revenue from it. And the debate always, particularly with larger acquirers, is do I do it myself and build my own lending business, funding business, or do I partner with someone? And if anyone looks at Square and Square Capital and looks at PayPal, they've all built very successful funding business on the back of their rails, but they also have very large balance sheets and they have a lot of capital to throw at finding the right teams. Where we partner with businesses, they might have ambitions to go there. So what we do is we have a flexible platform. So we say, upfront, we'll pay a straight commission. You carry no financial risk. We'll carry all the risk. We'll do all the processing. We'll do all the collections, and you can white label it and badge it. So they can put their badge on, and so the customer perceives that it's coming from them and as a value add. As that platform grows, we'll then enter into a joint venture with them. And it's a scalable joint venture where they can participate at any level they want to, depending on how much risk they want to take. So they can have a 0 risk participation, they can have a 50% risk participation, or 100% risk participation. And at 100% participation, they're going to get probably 2/3 of all the economics that come out of it. And it's still more beneficial than them setting up their own business and getting 100%, but having to hire a CEO, a chief risk officer, chief operations officer, marketing, et cetera, and the infrastructure and systems. So that's how we work with partners, and it's been very successful for them and for us.
So you've just revealed here that retail capital has there are quite a few retail capital solutions out there that people are not aware. And I'll just a number of maybe can you say like how many companies are white labeling your solution today?
We probably I can't tell you offhand, I'd have to ask my team, but we're probably to 12, 13, 14 companies at the moment, of which sort of 5 or 6 make up the bulk of the volume. But what I can tell you is, so the shift under the retail capital brand, we pretty much are doing the larger deal sizes, much smaller volumes. We've now got to a point where our partner business is more than half our total business in value, and probably closer to 90% of our customers come through our partners. So smaller deal sizes, much higher volume. So it's certainly where we're going in the future, is building partner platforms to support other people.
Very interesting. And I imagine too that the appeal for the partners is beyond the staffing and maybe the risk assessment and that infrastructure. I think also as well as like licensing. It's essentially a turnkey solution for financial service providers that are looking to tap into. Now the question is it specifically in the markets? Like, is it in South Africa only, or can they take out the core of retail capital solution, take it to other markets?
We're about to expand outside South Africa's borders. We will provide a balance sheet solution in South Africa. So we're offering as funding as a service. We'll provide a balance sheet solution in South Africa where we put up the capital and the funding. If we're going to go offshore, by and large, we'll provide all the tech and all the IP that goes with it. But we're not going to take balance sheet initially. So if they have balance sheet, a banking partner, or their own capital, they can lend it and they can use our platform.
And one of the bigger shifts that we've all experienced over the past year is COVID-19. How has that changed credit assessment in South Africa, and maybe specifically for your types of target customer, which are retailers?
Listen, COVID-19 has been probably the largest stress test we can ever have in our business. So we were highly exposed. I'll give you the stats. In April last year, when we had lockdowns, our lockdown started 26th of March. For April, 9 out of 10 of our businesses weren't allowed to trade. So only 10% were trading. They were essential services. So we saw a 90% drop in revenue and 90% drop in cash collections and 90% drop in demand. So it was pretty horrific. We fortunately have a very strong balance sheet and we have an incredible team of people. So we weathered the storm well. April we were to 10%, May 20%, June about 35%. By July we're at 50% back into profit, and we had a record last quarter in the calendar year. So we bounced back very quickly, and it probably speaks more to the resilience of the SMEs and the entrepreneurs. It's incredible watching who survived and who didn't survive. And in simple terms, the people who survived were the people who adapted. And I guess it's the old Darwinian theory. But we saw non-essential businesses become essential business overnight. Restaurants became delis because they could sell food and they could license to trade. We saw restaurants that weren't allowed to have sit down become takeouts. We saw offline retailers becoming online retailers overnight. I mean, the most dramatic one I can think of was an online swimsuit business that became an online grocer overnight in 2 weeks. So instead of selling swimming trunks, they were selling green peppers. And the guys that adapted saw their way through the pandemic, and they've come out now with new business models. And it's phenomenal to see the successes. So through COVID, we saw probably a 10% mortality rate. So 10% of businesses didn't reopen, 90% did. Roughly half of those are probably trading better than pre-COVID because they've got a high demand product. Sectors like building material, sectors like gym equipment, bicycle shops, anything at home related where people are spending more time at home, redoing bathrooms, kitchens, furniture, etc. They are flying. They're doing unbelievable business. Sit-down restaurants, because of the social distancing, suffered, and they couldn't sell alcohol for a period of time. So COVID's been like a pretty dramatic impact, but in many cases positive. So we certainly came out of COVID leaner. From a risk assessment perspective, to your original question, leading up to the point we had uninterrupted trading history was easy. When we had to reopen, we didn't know whether these guys would start trading, and we didn't know what level they would be trading. So how do you assess them now? You can't use previous data because the world's changed. So we were doing more and more manual underwriting initially until we started getting that track record again and seeing trading levels and trading frequencies and so on. And then we rolled back into our old models. But there was a period of time when we couldn't underwrite them automatically.
So when you, for the people watching and listening to this, can you describe manual underwriting?
So manual underwriting basically is, we'll say to a customer, fill an application form out, which is your company details and who you are. We would do essentially a bureau check. We're talking about large deal sizes now. Credit bureau check to see their payment performance as individual directors to make sure there aren't any sort of large financial distress or non-payment. We would pull in bank statement data, and bank statement data tends to be very predictive of general behavior of the business. So, are they meeting their direct debits? Are they paying their rent? Are they in arrears? So it's those types of things that we'd collect. And then we'd have a manual assessment. So we'd have a committee we'd get together on a daily basis and review those applications and go, we know the industry is trading, we know he's meeting his obligations, et cetera, and on that basis, we'd either approve or decline. And that's ideally not how you want to run the business. But you have no choice when you have limited data. Once I started building track records again, we went back to automated processing and didn't require manual committees and so on.
So when you say building track records, did you mean with the shift happening and the success that you saw on the new manual underwriting that you were doing, you then had enough information to inform an automated system to accept those credit applications automatically?
Exactly right. So we have tried and tested parameters we built over the last 10 years, which says this is the level of exposure we can take for that level of turnover or that type of business with that type of margin. So different businesses have different margin levels. They can afford to carry different repayment levels. And if you have someone that is consistently doing $100,000 a month, COVID hits, they do zero for 3 months. Now, where do they pick up again? Are they going to go back to $100,000, $150,000, $50,000? At $50,000, can they survive? And if it's a low margin business, they probably can't, or high fixed costs. it's a high margin business that probably could. So those are the debates you have, in the restart process. Once they're trading again, the new level is 80,000, not 100. You can then start applying all your parameters again automatically.
Amazing. So actually, that raises another question around the credit assessment model or algorithm that powers retail capital. Now, you say you work with retailers. There are different types of retailers, and I have two questions on that. Do you have a specific niche within the retail category that you focus on? And the follow-up on that would be, is your algorithm transferable or adjustable to other categories, whereby maybe these partners that want to leverage your solution could serve another customer base than the one that retail capital currently serves?
Yeah, great question. So we don't limit who can apply. We don't limit who can access credit, and also we don't limit what they use it for. So the original model was based on anyone who accepted a card transaction, so be it debit or credit. They could be service businesses, they could be online, offline retailers. It didn't really matter. What tends to happen is you do get biases by what customers who choose to use it. So we tended to fund 25 to 30% of our portfolio were restaurant owners, which were probably the heaviest impact through COVID, and largely because their businesses aren't easy to fund. So they tend to have low levels of assets, liabilities. Banks typically won't fund a restaurant owner. So that's why they tend to use our type of funding. But we have a broad range from travel, tourism, health and beauty, restaurants, food and beverage, etc., as well as services, could be plumbers, etc. And we obviously built models that cover all those segments. Where you have someone who's got a different proportion of industries, it'll still apply. You may see slightly different behavior from market to market, but it's a learning algorithm. So it's a fairly short-term product. You typically do 1 or 2 cycles, you know exactly what the risk rates are, and you adjust accordingly. So when we launched our product with our partners, we were using new data. We didn't have parameters at that point. We had high-level parameters, but no parameters per partner. So each partner has bespoke scorecards. We will run 2 or 3 cycles. We'll take risk on a level of client, and then we'll adjust accordingly. So we would see loss rates initially of 15 to 20%, and through 2 or 3 iterations, we're down to loss rates under 5%. So that's a data learning exercise that you go through. That'll happen for any market you go to or any industry.
And I imagine the cycle would depend on the type of the subcategory of business, or do you refer to cycle as a year?
The cycle typically is the term that you'll offer. So okay, if you offer a 12-month term on day 1, you'll need a year to see the payment performance.
I see.
And if you have to go through 2 cycles, it'll take you 2 years to learn. So what we tend to do is we tend to do shorter terms initially, learn faster, build the models, then extend term over time.
Amazing. Now, you mentioned that one of the data sources that you use to inform your credit assessment is credit bureau information. And as you well know, in a lot of other African countries, credit bureaus do not exist, or are pretty much the data that is being reported to them is very, very sparse. So in such economies, what would be, what would be your suggested approach, or how do lenders like yourself, how would you say lenders like yourself should operate?
You need to go back to transaction level data. So in the evolution of scoring, risk scoring, the base level data was demographic type data. Where do you live, et cetera, which is fairly weak data, but gives you some separation. The best you can find is behavioral type data or transaction level data. So what many of the operators, the lenders in the African countries are doing is they're using MNO data, so mobile network operator data. So be it call data, be it mobile wallet data, be it transaction level data. So they use that to build their models. And we were involved in a number of those in Kenya and Tanzania and Ghana, etc. And that's predictive data. All of these markets will determine, so the strength of the data will determine the length of term you can give and the level of exposure you can take. The stronger the data, the longer the term, and the bigger the facility. Weak data, you have to get into a learning algorithm, which means you almost need to take a small exposure short term, weed out the non-payers over time, and continue lending over time, increasing amounts to the people who do pay. So it almost becomes a behavioral model than a straight transaction predictive model. That makes sense?
Yeah, makes sense. So does retail capital have programs to help startups get ready to access credit or qualify for credit if they initially do not?
So we generally don't fund startups as a business. We do make resources available to startups if they want it. So on our platform, we have access to, be it providers for accounting data, be it providers of social media support. There's a bunch of resources available they can tap into at any point. If anyone applies that don't quite meet our criteria, and our criteria is fairly short term. So within 3 months, you could be accessing funding. So, which is typically still a startup, but we're not going to do it pre-revenue, if that makes sense. And we'd give them advice in terms of things like, get a payment device, go and get yourself an acquiring mobile point of sale device, start taking card transactions rather than cash transactions, and in 1 to 3 months you'll qualify for funding automatically. You'll be automatically assessed in the process. So there is access to funding fairly quickly, and there are resources they can tap into on our platform.
Gotcha. So just looking forward, where do you see credit going? I mean, and that is a sliver of fintech. I would like to ask you about your vision for credit and credit assessment and offering credit in Africa, and then the fintech space as well. That credit is just one piece of it, and I would like to hear about your take on where that space is going as a whole.
Yeah, so credit on its own is a massive topic, in that you get consumer funding and you get business funding, SME funding. What we're seeing is, in many cases, the consumer credit side is being overexploited in many countries. And we've seen it in South Africa for the last 20 years. We have roughly just under half our population have credit impaired records, which means they're not meeting their monthly payments because they've had so much easy access to credit for so long. So we have a consumer credit problem in South Africa, and people are fighting over the handful of people left who have good credit records. If you take Kenya as another example, they've had a flood of credit over the last sort of 5-6 years into the market, particularly as the fintech lenders have gone into that market and started opening up credit. And the challenge there actually is they've created so many impaired records for small loans. So people are taking $1, $5, $10 loans, not repaying and getting a bad credit record. So they have bureaus, and that's being shared. And the regulators are concerned that a large part of the Kenyan population have impaired records for small amounts of credit. So credit for consumption, credit at the consumer level is a dangerous game that needs to be managed in some form. And we can have long debates around this. And I'm sure that the lenders in those markets won't like me saying it, but you've somehow got to find a model that can be more responsible. The area that we're going to see a lot of growth going forward is in the business lending space, the business funding space, and largely because it tends to be non-consumptive lending. It tends to be investment into growing a larger infrastructure. So if you're using the capital to buy stock or expand your floor space or buy more furniture, which leads to higher turnover, it becomes self-funding. And what I always say to people is, you have, in the consumer space, it's easy to give money away, hard to collect. So high demand, but you have a collection problem and a bad debt problem. In the SME space, it's the opposite. You tend to find it hard to give it away and easy to collect. And the main reason is the business owner who's taking it tends to be more financially savvy. They can look at it and say, I'm borrowing $100, I'm going to pay back $110. If I can't make more than $10 profit on the $100, I shouldn't take the money. Okay, so they tend to think through the process more before they take the funding, and they use it productively. So the SME funding sector, I think, has got massive legs across Africa. There are many new sources of data coming out. More and more businesses are becoming digitized. So that's a major shift. As you move from a cash economy to an electronic, I won't say a credit economy, an electronic economy, where there are digital payments being made, whether it's a mobile payment through M-Pesa, through Lipa na M-Pesa, or whether it's a card being swiped, debit or credit. Once you have a digital footprint, they can access funding. And you can build very strong models and very good predictive models using that data.
So, and going back to these SMEs, it seems like part of the opportunity would be to increase the numbers of SMEs that are willing to get that credit. Now, what do you think needs to happen for those business owners to say, hey, yes, I actually do want to have credit? Because one of the bigger problems is essentially, in terms of any form of technology, is that adoption. And what do you think would drive adoption for these small and medium-sized enterprise business owners to say, hey, yes, I would love to go and get credit? Because what that would mean is, from a lender perspective, like you said, SME is hard to give away, but easier to collect. You want more business, but to get more business, you need to have more SMEs willing to get that credit. How do we get there?
So I don't think it's necessarily the funders trying to push more down the pipe. I think you need to create an enabling environment. So every business at some point needs cash flow or access to funding. Okay, so I say to my team, it's not that people do or don't want funding, it's a timing issue. So when I offer it to you today and you're in the middle of your peak season trading, you may not need the money. You're cash flush. But you're going to have winter months where your customers aren't coming and buying from you, where you have a shortfall. So every business goes through cash flow cycles. What you want to do is create an enabling environment where you can make funding available when they need it, readily available. So if you can give them, what we do with our partners is, if you can give them a line of credit that's available all year round, based on their current trading history, which they can access if and when they need it. So you don't need to be pushing anything to them. They will come and ask for it when they need it. And we've had many conversations with business owners where the business owner will say, but why would I need funding? And the financial guy will say to him, but last week you were offered so much stock at a 30% discount and you didn't have the cash to buy it. So you missed the opportunity. So opportunities come up all the time, and cash flow cycles move all the time. So it's more about, how do you get the business owner to change his practices, where he says, I know that by changing my payment type from cash to card, it'll be available in the future, whereas it cash it won't. And across many African countries, half the reason people take cash is so they don't have to declare it to anybody. And they pay the suppliers out the till, et cetera, et cetera. So there's a real fear of having to be forced to pay tax and other things in the process. But that's the mindset you have to get over at some point.
Right. So I guess the trade-off for a business owner is, do I accept digital traceable transactions and potentially pay more taxes? Or do I accept that and be able to then get financing that will allow me to make more money. And the question is, what either saves me more or makes me more money?
Sure. Listen, I think there's so many factors involved in that decision around safety of cash. I won't get robbed every week. In some environments, it's a reality. So I don't think people necessarily want to carry cash or hoard cash. I think they want to be electronic, but they're hurdles to get over.
Yeah. So now zooming out a little bit of credit and looking at the fintech space in general, South Africa, it's a pretty booming market in terms of fintech in Africa. And there are several different other categories of fintech payments, for example, wealth management, savings, and several different other products. Where do you see the biggest opportunity, and how do you see all those kind of categories playing together in the fintech ecosystem? And you could take the South African case.
Yeah. So at the end of the day, you want to look at the industries that are most open to disruption. I think the payment space to a large extent is now quite crowded, and there's been a lot of consolidation. Certainly one of our shareholders has been consolidating offline payments and online payments into large groups that are being sold. So, and it does require rails that are registered with banks and with regulators so a lot of regulatory structure around payments. So I think the payment ship largely, I think, has sailed unless you find certain niches. The other big one is money remittances, transfers across border. That seems to still have some traction that you can get into. And for me, the big space, I think it's still largely untapped, is the insurtech space, where you've got very large insurance balance sheets, where people can access products through traditional insurers, and there needs to be more innovation in the insurtech space. So and the difference is funding to some extent is a demand product. In the insurance space, it's more of a grudge purchase. So how do you get in front of someone and they sign it and they want to take it? And they don't get up in the morning saying, I want to buy insurance.
Yeah.
So, but that insurtech space, there's a lot of capital tied up in that industry, and it's ripe for disruption in particular.
So insurtech should be the move. And okay, that's very interesting. So looking at the South Africa startup ecosystem, and you're very active in that entrepreneurial ecosystem, what would you say are the key players in South Africa around just startup entrepreneurship ecosystem? And this is a question from the audience. It's a very broad question.
So participants in it, or funders in the ecosystem, or are there any specific parts? I can talk to all of them.
Yeah, Anthony, was there any clarification around that?
Sure. Mostly, what are the biggest incubators, accelerators that you deal with or that are familiar in South Africa? And what other organizations are pushing for entrepreneurial success?
Okay, so if I look locally, so in Cape Town, you got Silicon Cape, which is a great facilitator of startups. Incubators, the likes of Alpha Code, that sort of sits under the Rand Merchant Investment space in Joburg. They've been very active in that fintech and tech space, supporting. A lot of the support is also coming from early stage investors, and I can think of a couple. And then you get into the VC space, which is probably slightly larger. So not so much the startup level, but once you want to start scaling, you've got the likes of Knife Capital. Kit van Sale runs a great shop at Knife Capital. Got 4DI. So there are a bunch of guys that are investing in the sector. Crossfin Holdings are investing in the sector. They tend to play at more at the growth stage than the early stage, and the very early stage. There are some venture funds. RCS tied up a startup bootcamp type process as well. So there are a bunch. I mean, we can offline send a list of who the players are if they're interested.
Interesting. So going through questions from the audience here. It's a long one here. I'm going to read it out. So after you learned the structure from corporate, and that's going back to the initial piece of this conversation. So the question reads, after he learned structure from corporate and previous experience, how did he manage to avoid recreating the structure, which can be frustrating to those trying to make decisions at lower ranks, given that the structure previously frustrated him when he was lower in rank while working in corporate?
It's a great question. Okay. So let me deal with some of my pet hates. Okay. So one of the things, I'm a big believer in HR as a function. I'm not a believer in HR departments. Okay. So the first thing that we pushed back against when we started RCS under Foschini Group. So I worked for Foschini as a corporate. I started another business and came back to Foschini as a shareholder in partnership with Foschini. And the things that frustrated me at Foschini in particular was slow IT delivery. So if you try and turn around an application in a large corporate, you could be sitting for 12 months on a priority list and never get a look in. You're a non-starter in terms of IT priority. So the first thing we said to them on day one is we will use our own IT department or our own IT tech. We'll buy our own tech in. Secondly, the thing that frustrated me most in the HR space, in the corporate, was things like this corporate policy. No one gets more than an 8% increase. Can you imagine all the tech guys only getting 8% increases every year? You wouldn't have any working for you. And that's what happened to large corporates, is they spent 2-3 years, built their career and said, thanks very much, I can earn double my money somewhere else, and left. So you end up having all the great skills leaving early on, and the mediocre skills climb the ranks. And that's why I ended up with the corporates. So when we went back to the corporate, we were very clear about, we're not going to adopt your HR policies. We will pay people what they deserve. We'll not use our IT systems. We will go and hire our own IT in. And then as we started growing, which I think is part of the question, is, they say the optimum number, or the maximum number any organization should be is 150 people. And you can go and research that. And it's related to levels of relationships. So when you have 2 people, there's only 1 relationship to manage. When you have 3 people, you've got 3 relationships to manage. And so it becomes exponential. When you get to 150 people, that's roughly the time when you don't know everyone's names in the organization. And that's when relationships start breaking down and you start needing to put structure in place to control what goes on. So, and the one business that I was running, we built to 800 people. And you can imagine, you can't know 800 people's names every day. So you've got to put other stuff in place. So the one thing I've learned is to try and keep your structures as flat as possible, so you don't have layers and layers and layers of management. So you're not at the bottom of the rank trying to get your message up and it gets blocked all the way through the system. Secondly, we've always said we want to be relationship strong, structure light. So we don't have thick manuals of policies and procedures. The other approach we've always taken is to say, if you treat people like adults, they behave like adults. If you treat them like children, they'll behave like children. Corporates treat the people like children. So they put rules in place for everything. You may not fly outside of working hours. You may not have a desk that has 2 visitors' chairs because you're not the right level. That sort of stuff. Avoid all of that stuff. So we've got very light policies in the business. And the other thing about HR in general, let me explain myself, is it's a critical function. You need to have the people function to make sure that you understand testing culture, engagement, all that sort of stuff. What you don't want is for HR to undermine the relationship between a manager and their subordinate. So when I have a problem, do I go to my manager and say, listen, I've got a challenge, let's resolve it? Or do I go to a third party and say, I've got a problem with my boss? Because as soon as it happens, you drive a wedge, you disintermediate your relationship. And large corporates do that. They disintermediate the relationship in the organization, the line, which breaks down the culture. So you end up having more HR people to deal with more unhappy people, and they're unhappier than they ever were when you had no HR department. Anyway, I can spend lots of time talking about this stuff. But it's a great question. You have to be very conscious of how you build your organization to keep the relationships up, to keep the culture up, not put lots of rules in that people feel like they've been treated like children, empower people. I think one of the best things that's happened through COVID is the fact that it's forced businesses into work from home. Pre-COVID, if you said to me, we could send a whole operational team home and they'd all work as well as they did before, I would have said unlikely because there's no supervision. What happened? Some of our poorer performing staff are the best performers at home. And in fact, we lost no productivity and they all worked from home and they didn't have supervision. It's changed mindsets. It's a great thing that's happened from that perspective. So I think there was a general mistrust in corporates that people do their jobs. That's not true. Treat them like adults, they'll behave like adults.
Thank you very much for sharing that. It all boils down to the people at the end of the day. So I know we've come up on the hour here, and before we let you go, and we're so thankful for your time, wanted to ask you about any predictions about the fintech space, the tech space, financial service, any predictions you'd like to make, and maybe drawing people's attention to maybe something that is not being talked about enough, or something that entrepreneurs might be missing in pursuing tech entrepreneurship and stuff like that. So
I'm just going to read a quick quote. So today, Jamie Dimon, who's the CEO of JP Morgan, put out a 66-page letter to his investors. Okay. And I read a couple of the things that came out. He talks about competitive threats. His warned shareholders there's disruption from technology at hand. Traditional banks are being consigned to a shrinking role in the financial system. And he goes on to say, banks have enormous competitive threats from virtually every angle. Fintech and big tech are here big time. And then he talks about financial technology firms are more formidable, offering easy to use, fast and smart products, he said. Shadow banks, a group that includes investment funds and online platforms offering financing to companies and consumers, are winning market share too. And he talks about how they've done a great job at reducing pain points for customers in the fintech ecosystem. Up to now, fintech hasn't been taken seriously enough by the banks because they haven't dented their profits yet. They haven't had scale. With the big players coming in, the banks, and Jamie Dimon says they're going to put more money aside to acquire fintechs and build into that space. So if you're a fintech entrepreneur right now, insurtech, whatever it is, your time for collaboration is now with those big players. They have balance sheets. You've got technology and you've got systems and processes they don't have. It's very hard to work with banks or insurance companies. And I speak from experience. They tend to want to control everything and own everything. And they tend to kill it. But there's a growing realization in the banks that they need the fintechs. And they've also realized every time they've acquired a fintech and not looked after the people have left and they're left with just technology, which doesn't work. So, if I've got a prediction, I think the next 3-4 years, you're going to see a lot more collaboration between banks and fintechs, a lot more mergers and acquisitions, M&A taking place, high valuations coming through for them. It's a great time to be in fintech and tech.
Amazing. Very powerful. I know Anthony had a curiosity that came through the chat. So Anthony, I'm going to let you share that.
Thank you. The question was really around if you do invest in any startups, or if you have invested in the past in any startups, and if yes, in which sector? Is it fintech, or is it more of an SME or other sector?
Yeah, so that's a great question. So first and foremost, I pretty much am fully invested in my own business. It's the best place to put your own money is where you can see it work. So I have very little outside my own business. But you do come across these businesses where you love the founders, you love the concept, and you want to put something behind it, and not because you want a return, you just want to make sure they're successful. So I spend a lot of time mentoring startups and founders of businesses. I put investments into businesses not to see a return, because the reality is you don't see a return in these things for a couple of years, for quite a while, but you want to make sure they're successful somehow. So my investment level is pretty low in other businesses because I'm fully invested in what I do. But I do. I'm emotionally invested in many other businesses. And in terms of sectors, I've been helping guys in the ed tech space, and that's not my forte, but I'm sure I can share my skills and wisdom that I've built over the years. But I'm not an ed tech specialist. But the ed tech space is exciting, especially moving now to work from home, online courses. The physical education is being replaced by online education, which is fantastic. And as I said right in the beginning, I've learned that you can be super smart and read a ton of stuff. If you're not working in the sector you've grown up in, you're going to make mistakes. Someone's going to know more than you do. Whenever I get involved in a lending type business, it's in my blood. There's not a lot that I need to go and research in the lending type space and credit space. So if I'm going to make investments, it's going to be in my core business.
Great.
Nice.
Thank you for that.
Thank you very much. And we've now kept you 6 minutes over the allocated time. So thank you very much, Karl. If you have any parting thoughts, parting words you'd like to share with us, please.
Just a thank you to you, Boum, and to Anthony. I think what you guys are doing with Africa Startup Labs, you're creating another part of the ecosystem that all of the guys need. And probably the biggest, and it comes back to what we spoke about earlier, many of the fintech entrepreneurs are young. It's early stage in their careers. They haven't necessarily been exposed to lots of systems and lots of other things that are happening out there. And the more support we can give them through mentorship and these types of structures, the better. It's a great initiative. So well done.
Thank you very much, Karl. We appreciate the kind words.
Appreciate it.
Well, on that note, thank you everybody for following us today, and you'll be able to watch this on our YouTube page. And Karl, thank you very much.